today we have Will Rhind, who is the president and CEO of Granite Shares ETF, which has a tremendous amount of very, very interesting products that we're going to talk about. And we're going to talk a lot about macro. But before we do, we want to thank our sponsors. First of all, Independence Arc Farm. Marco is one of the best purveyors of grass-fed, grass-finished beef. It is amazing. Independence Arc Farm. Secondly, American Gold Exchange. The time for owning physical silver and gold seems to be now. I don't know if you guys have looked at a chart today, but it seems to be right now. American Gold Exchange, you can find the link on our page. Also, unfilteredinvestor.com, where Mike Arnold and Bob Iacino take all these market moves and use technical analysis to chart them out on short, medium, and long-term timeframes. Thank you guys for being here. Will, how are you? Where are you coming to us from, first off?
I am well, thank you very much. I'm coming to you today from New York.
Is it as cold there as it was here yesterday? Is it around zero or no?
Yeah, it's freezing.
Yeah.
We got snow on the ground, so very, very cold.
Yeah, and it honestly has put me in a bad mood. Like we adopted this dog like it was a stray like 6 months ago, and she can't go outside, and she's so furious at me. She thinks I did this cold thing. She keeps looking at me like, "What's the matter with you? This is a hell here," because she's from Texas. But anyway, so I can't wait to I'm going to Arizona tomorrow, so that should be a little bit better. But Bobby, I will be there in time to do the other show. Bobby, how are you today?
I'm good, man. I'm good. I was actually freezing down here in Southwest Florida, but I'm not going to complain about it to you two guys.
I wouldn't either. I wouldn't at all.
Start the show off bad.
Will, we're going to do about 10 minutes and just to try to break down what the hell's going down in markets today. The title of the show is Trump's Folly, play on Seward's Folly for you history buffs. And will Greenland become the 51st state? So, okay. So here's my take on it. Then I want each of you guys to go on it real quick too. I think it's very, very interesting that stocks are getting pummeled at the same time 10 years are being sold. When Denmark came out and said they were potentially going to sell their U.S. treasuries, by the way, in their pension fund, they hold about $100 million of U.S. treasuries in their pension fund. So it's nothing. But it's interesting that they're selling because it's definitely a line in the sand. Like, we want financial retribution to the United States. So yields are going higher at the same time stocks are going down. That to me suggests that it's more serious than just another one of these Trump follies. I still think it will work out with some great negotiation. Trump doesn't want us to know what he's doing. Will, do you have any opinions on this so far?
Yeah, I think it's kind of double whammy, whereby you've got a big sell-off in Japanese bonds.
Huge.
Overnight. Yeah. So the Japanese 30-year particularly rose to highs. That's causing a bit of a disruption in markets today, to say the least. I think it's part of the extension of the global debt problem, which everybody is familiar with, and governments kind of reaching the limits of really what they can do with regard to financing their economies, providing growth with the amount of debt that's been sustained. That obviously, with what you just talked about with Greenland, particularly Trump threatening the Europeans with tariffs again, has caused another sort of tantrum in the markets. So I think we're dealing with those two things today.
That's interesting that you bring up the Japan thing too, because I've been talking about it for about a month, just saying we have a real-time experiment of how profligate spending can't go on and on and on. And all of a sudden it's blowing up in real time. Do you think anyone on our end is going to look at that and say to themselves, maybe we're doing this wrong, we should change our course? Or does the bond market have to flex its muscles and make them change their course?
I'd like to say yes, Jim. And I don't want to sound too sort of skeptical or cynical about it, but it just seems to me like, the more that debt keeps increasing, the more governments want to spend or more politicians want to spend. So I don't see really any kind of discipline or any kind of, moment of clarity or sanity, real change being affected. So from that perspective, I think it's the markets that kind of have to try and step in and really adjudicate or administer some kind of reality.
Bobby, to you, do you think what we're seeing right now is the beginning of the bond market flexing its muscles and saying that you got to behave yourself, or is that just too far off?
Well, I know a couple of things. Number one, I know that Japan is actually repatriating capital when you get a 10-year yield. That goes to the highest level since 1999. There's been comments from officials today out of Japan who said we don't want financial markets to end up in chaos. They may be looking to intervene against any further fall in the yen. Those kinds of things I feel like we have to analyze as a more of a wait and see. I hate to steal Rick Santelli's phrase, we'll have to wait and see, but I kind of think that applies here. The gold move to me, because of what happened in Japan, simultaneous to the tariffs, people often, I think, conflate flight to safety and flight to quality as being the same things, and I don't think they are. I think a flight to safety involves something like a war or some sort of disruption of bond payments by a major government. A flight to quality is when you have something like maybe tariffs and Japanese yields rising, and you have the global economy reacting to it and saying we can get a slowdown from these things if they get out of control. That's more of a flight to quality trade. And Will, this is something Jim and I have been talking about for probably since 2024 at least, where we're trying to line up the things that are going to get gold to sell off measurably, and they don't ever line up. So do you disagree that, there's obviously factors that can drop the gold price, but not the least of which being that it's a little overdone. But where do you think we're leading in terms of the fundamental drivers of putting gold maybe in its place a little bit?
I mean, I think you have to have reversal of the environment which is causing gold to go to highs, which, namely is you'd have to have a strengthening of the dollar. That probably means higher interest rates. And maybe ironically, that's caused because of a reemergence of inflation. And it's reversal of the current situation where markets pricing in weaker dollar, real interest rates falling, more money printing, looser fiscal conditions, and all of the geopolitical premiums, et cetera, that go in it. So it sort of almost, to me, has to be a reversal of all the situations that are causing it to rise now.
So I have
That's
a quick
something I
question.
don't have hope in, Jimmy. It's a reversal of those things.
Well, we just said, like James Carville said, when he dies, he wants to come back as the bond market because everybody's terrified of the bond market. And the only way we move is if the bond market starts forcing us to, a la Liz Truss. So let's just break this down real quick. Is that because I also have a third element. We mentioned the talk about Greenland, the escalation, the European, which Giorgia Maloney says, by the way, that the European leaders who have made such a huge deal out of this are absolutely as culpable. I know that Giorgia Maloney always likes to ingratiate herself with Trump. The battle lines have been drawn there. But we also see Japan. But also, is there an element of just market position? We've been flirting around with all-time highs for a long time. Valuations are clearly stretched. We've had a bit of a sideways correction in the NASDAQ, but nothing material. Do you think this same story in a situation where the market was fairly priced, would we yawn, Will? Is that part of it too as well?
Yeah, I mean, we haven't had a tariff-based sell-off for a while now. And so I think there was a point where, the market had moved on from tariffs. And you're right, Jim, that any kind of, tariff musings, if you want to call it that, the signal was getting weaker and weaker. And I think what's changed this time is that you still got the signal, but it's been amplified by the fact that there's some geopolitical positioning around it as well, as opposed to just, hey, we're thinking of increasing tariffs on XYZ country.
Right. Bobby, in your newsletter, which happens to be my newsletter too, we talked about how markets were priced for perfection and that Mike Arnold thought the risks of a down move had become materially higher, and he went to neutral on equities just several days ago. Do you stick by that? Do you think that, again, at our age, every time the market starts to turn around, everyone debates whether or not it's the big one. The big one involves years of leverage speculation filtering down to the mom and pop. This looks to me like a garden variety correction that might be beginning. Bobby, do you think it's even that?
Yeah, no, I don't even know if it's going to be a correction. The reason I say that is people use this phrase taco, Trump always chickens out, but I think more Trump taste tests things. He throws things out there to see how they're going to work, just like a chef tastes their food as they're cooking. You imagine what Trump would cook? Would it be like a
hot dogs, steaks with ketchup. By the way, did you just make up this taste testing thing off the fly, or did you have that written down? Actually, but Bobby's not usually very smart. When he comes up with something creative, it's like, wow, he nailed it. Anyway, continue. I don't mean to interrupt.
Well, first of all, I think smart and witty are two different things, and I'm not sure which one
and Bobby's very, very smart. I'm
not sure which one I am.
Yes. Okay.
No, I mean, he throws things out to see how they fly. And then, I'll give you an example that just happened recently. We might go into we might do the Insurrection Act. We might punish Iran if they continue to murder people. And then I think Trump said, well, they've only murdered like 30,000, so we're okay with that, right? So he throws things out to watch not just a market reaction, but an overall reaction. I don't think he cares as much how the media reacts as he cares how markets react and some of the people around him. Scott Bessent, for example, just talked about, I'm going completely off subject here, but he talked about how one of the reasons they can justify stopping institutions from buying single family homes is the tax treatment. And it made me convinced that Bessent must watch this show, because we just talked about that.
We did a whole episode on it. Yeah.
We did a whole episode on it. When Trump throws out something like tariffs on 8 European allies if they don't support us putting Greenland into the United States in some way, shape, or form, just seems silly for the market to react to me. And that's why I keep going back to the Japanese thing. Will, which do you think has more basis on what's going on with the equity sell-off here? Or is it just a combination of both things happen on the same weekend?
Yeah, I think the Japanese thing is serious. It goes back to the Japanese sort of tantrum, what was it, last summer? And so this is definitely a real thing, that you can get quite serious, bond market reverberations from a sovereign like Japan.
Will, can we do like a game where we talk about all the different levels of ripple that can happen? The first one being perhaps they start buying their own bonds, which could beat the shit out of their currency, correct? And how does that make its way over to our shores?
I think look, to me, there's, I suppose, the practical implications of that, which is you're chasing a currency down. Japan's an export-led economy. Therefore, you're signaling a behavior which is a competitive race to devaluation of currency, because no one wants to be the currency that's an outlier with high interest rates when everybody else is low. And that's in part why you see everybody from the Fed to other major economies in the world somewhat lowering interest rates in lockstep or raising interest rates in lockstep, because nobody wants to be the outlier and have their economy uncompetitive versus others. So I think it causes that fear that other countries have to react quicker, and then within that it causes fears that, okay, if we lower interest rates, we might spark inflation again, and or we might spark an unwind of our own currency in a way that didn't pretend. So I think there are multiple factors which go into play here.
Do you guys see any risk in a carry trade unwind? Do we even look at a carry trade unwind in here anymore, Will?
I think, that's what I was alluding to just in the prior comments about when we saw the last sort of big ripple from Japan. And I think there that was really the first big sign that things had changed in Japan. Mm-hmm. And again, I'm not an expert on all of the positions that are in Japan and the yen carry trade per se, but my understanding from that situation was a lot of that money sort of got washed out after that and sort of was reallocated or redeployed elsewhere. So I think this time around, it's less about a yen carry trade per se, and more just straight up concern about the Japanese bond and debt situation.
So it's interesting you say that. Sometimes I think the unwind of the carry trade is something that people use when they can't find a real reason for a shift coming between the dollar and the yen. And I say that Jim and I are both ex-CNBC guest analyst veterans, which I regret with all my heart. But it's...
I don't as much. They paid me a lot of money. But anyway, go on.
What's that, Jimmy? What's that?
I said they paid me quite a bit of money, so I don't regret that part. Right?
I just I look at it. We used to be on with people, and they would say, "Well, what's going on with stock market today?" Well, this is a technical move. And every time they said that, I'm like, "What are you talking about? It's a technical move." That to me was an excuse for when you had no idea what was going on. Whereas the two of us, I'm going to assume the same with you, Will. It's like I have no idea sometimes why things move.
Yeah,
and I often don't care, because to us, investing in markets is about structure and how you manage risk, not about how not about why something happened. Why to me is like a hobby. So if we look at it from this point, what does Granite Shares do to help in that kind of an attitude? Just tell us what Granite does. And how do you help investors not necessarily worry about why something happens and rather about what is happening in their investment portfolios?
Yeah, so we at Granite Shares, we're an ETF issuer. So that means that we create all sorts of different ETFs or exchange traded funds. So everything from ETFs on gold, which literally just invest in physical bars of gold in a vault, to more complicated strategies like leveraged ETFs on popular stocks, both long and short, income strategies of various varieties, and we have products listed here and in Europe. So think of what we do as like a big menu of different investing options. And it's all really designed for the self-directed investor who wants to take specific views on all sorts of different markets or situations. And we provide the tools to do that. So whether you're bullish or bearish, hopefully there's something in the toolkit that supports your particular view, regardless of what the market environment is at that time.
So if Jim and I and our partner in our newsletter want to create an ETF, we can call you.
Yeah.
I do have a couple questions about that.
Serious, yeah.
That's what we know. Yeah, because I have been working fairly tirelessly, and I sent Bobby the white paper on I call it the old F's portfolio. For me, it's something that's designed for a cohort that's above 55 or 60 years old and seeks, again, if you could find a portfolio, if I discovered a portfolio that back tested to like an 8.5% yearly return, but the biggest drawdown even in 2008 even was only like about 11 or 12%. Do you think that's marketable to old people, or does everyone just want risk?
Well, it's definitely marketable to older people, for those that are looking for that. I think what I've learned in my experience is that I guess what makes this job fascinating for me and interesting probably for all of us is that it's just like the market's so big in terms of the spectrum of ideas and people's investing styles and appetite to risk. And so what works for somebody may not work for somebody else. And there's no right or wrong answer. And I think that's the great thing about investing to many degrees. It's really a combination of what goals you have and ultimately your attitude to risk.
So do you have, it's a portfolio that has like a dynamic options hedge on the equity portfolio that's designed like to take advantage of theta at the same time it's providing risk. Again, I guess I was just looking for an attaboy. Forget my portfolio. Let's go on. Let's go talk about something else. Bobby, you go.
So this brings me to, I mean, ETFs are obviously easier. I was an investment officer at a fund of funds for 8 years. And I was in the fund for 2 years first. So I was brought on as an investment committee member. So that was 6 years. And over the course of 9 years, this particular fund of funds returned an average of 7.8% per year. And it had one down year in 9 years, and it was 56 basis points. And what I found with that kind of a structure, and again, this was a fund of funds, there was a management fee, and then there was a cut of the profits, and it wasn't a very big cut of the profits, and it wasn't a very big management fee. But for that kind of a structure, you need hundreds of millions, if not $1 billion, to pay staff, right? You just don't make a lot of money if the returns are in that 7 to 9% range on the incentive fees. Do ETFs solve that for some people? If they put this thing together, is that one of the things that ETF does as opposed to going to a fund that looks the same?
There's a couple of things. So yes, the ETF structure has definitely, I think, simplified a lot of the investment structures out there and become the wrapper or the investment structure of choice for investors. That we had record amounts of inflows into the industry last year, record outflows for the mutual fund industry. And that's not necessarily a headline story, other than for one day. It's something that's been going on for the last decade plus. So definitely simplifies things, makes the cost lower. What you deal with ultimately with ETFs is scale. And like any kind of scale product, it allows you to operationally improve expenses. And that's why you can see some ETFs that are practically free.
So here's another question about constructing an ETF. When you construct a new ETF, can you use existing traditional ETFs within that?
Yeah,
That's
absolutely.
That's what I thought. Yeah, some of yours probably do, right?
They do.
Yeah, once you have a liquid product like SPY, it'd be stupid to go out and try to create your own basket. It's already created. Yeah,
That's right. So similar to what Bobby was saying, you can have a fund of funds,
right. Yeah.
so an ETF fund of funds,
Okay.
and
So
that's
yeah,
an ETF will invest in other ETFs. It's
per-
perfectly fine.
perfect. So what are your most highest flyers? Isn't the right? What's attracting the most interest right now? I assume it's the metals ETFs that you're offering. Is that correct?
I would say, honestly speaking, which might be a little bit controversial given what we've been discussing up until this
We
point,
love controversy.
it's still the same continuation, which is tech stocks and in particular AI. I think that's still the bulk of where people are positioned. Yes, gold, platinum, silver, these other things are very popular right now. Income, very, very popular. And almost, when is income not popular, right? It's
Right.
always popular. But I think the most, sort of profound trade in the market for investors, and particularly for self-directed investors, is still AI, and therefore that's still where the money is focused. And if I had to bet, at the end of this trading day, we would see the most amount of inflows.
So when you say AI, because I've over the last couple of weeks / months, I've been looking at the AI trade as much differently than I did before. I think we've seen the Nasdaq go sideways. We've seen Nvidia at one point being down 20%. I think it's broadening out. You mentioned silver and platinum. You didn't mention copper, but if you take silver and copper, I think that's phase 2 of the AI trade. When we talk about electrification and data centers, it's part, crypto's probably involved in that as well. One of the reasons that I increased my exposure to silver and copper was because of the AI trade. And then you look at the fact that the Russell's outperforming. I think of that as another element of the broadening of the AI trade. Do you agree with any of that?
Absolutely. I mean, I think it's not just limited to the Mag 7 stocks. Absolutely not. It's definitely broadening out. And, you've seen big lift. You mentioned crypto, but big lift in crypto from a lot of the Bitcoin mining companies or the mining companies that are pivoting to AI. In the crypto space, you have the power companies pivoting to providing power for AI data centers. You have the raw materials that are needed for powering all sorts of AI-based applications. You have the robotics company, like it goes on. And definitely we're seeing a broadening out where if 5 years ago we were saying that every company had to become a tech company, now we're saying every company has to be an AI company.
Fascinating. Bobby?
Got a question from our audience, Widge. He says the older people well, it's not really a question, it's more of a comment. He said the older people that I know just want CDs that cover inflation and maybe a little more, but they're not the kind of people you're talking about.
No, they are the kind of people I'm talking about, Widge.
Well, I think what he's trying to say here, and I'm not sure, and Widge will comment if I've got it wrong, is that he wishes that existed. And it leads to a question that I want to ask Will, actually. So current CDs are 3.8%, 4%, somewhere in that range. That is beating inflation. But with the restrictions of that, when you look at an ETF that say is, let's call it a risk-adjusted S&P or a risk-adjusted NASDAQ, it doesn't matter to me which one. If you want to mention a specific one, go ahead. When you're looking at something like that, people forget that in times of inflation, that also includes asset inflation. And that doesn't necessarily help people who can't pay their rent, pay for groceries, things like that. Are bank CDs and things like that essentially dead as investment vehicles in your view? Or do they still hold what they used to? My parents, that's all they looked for. Right? Yeah. They had no interest in the stock market. And now you got guys in their 20s saying, I'm buying stupid ass coin because I think it's going to triple. Where's this leading in your view?
Well, I think they're not dead. I think what's happening is that it's again a little bit of I suppose it's a somewhat of a commentary on society today, whereby we have, broadly speaking, we have a very wealthy generation of boomers who are principally in the preservation of capital mode, and therefore for them, it's more important not to lose money than it is to make or to eke out another 10%, 20%, whatever it may be. On the other hand, you've got a legion of younger investors who are completely positioned in the opposite direction. They're not interested in preserving capital because they may not have much capital to begin with, but they're 100% interested in accumulating capital or taking risk. Some of the levers of traditional growth are no longer there for them, such as real estate. It's very, very difficult to now jump on the housing ladder as a young, 20-year-old professional. It's just kind of out of sight. So the only mechanism left to accumulate and build wealth is the stock market. And it's never been as easy as it is today to invest in the market. You've never had more access to information as you have today, and you've never had better tools to do it. And so I think it's just sort of two opposite ends of the same spectrum. One generation is very much interested in preservation of wealth. On the other hand, you've got everybody completely wired to accumulation of wealth and everything in between.
It's fascinating. Bob?
I was just thinking as I was listening to you talk, I remember seeing a YouTube channel where they took people with your accent and had them repeat things that were said in like the hills of West Virginia to see if they sounded more intelligent than what the people in the
answer is yes.
What's that?
The answer is yes, of course.
Yeah, I mean, if Will were
London, you're from London. You're from London, right, Will?
I'm actually from Scotland, but I spent a number of years in London. I was living in London before I moved to New York.
Oh, see, I would have pegged that as London, not Scotland. And then when you hear London, it sounded not upper crusty, but like well educated. Where were you educated?
I went to the University of Bath, so southwest England.
Very cool.
I knew someone from Bath.
Yeah.
He used to make fun of me when I called it Bath.
I'm going to call it Bath. I'm from Chicago. We call it Bath.
Well, it's pretty much a Roman city, is it not? It's very like Roman inspired.
Beautiful. One of the only cities in the world that's actually it's an UNESCO World Heritage City.
Wow.
Yeah, an ancient Roman city.
But even like London was an ancient Roman city, Londinium, right? And like the whole country was first the Romans, and then they left when then the Danes came. So everything in London was Roman at one point in time. I mean, everything in England was essentially Roman, right?
Yeah, I mean, I think what I'm more specifically alluding to is preserved. So, authentically preserved, didn't get destroyed in the world wars.
I'd love to go see that.
Yeah, Bath, England actually looks like a Roman city, almost frozen in time to a certain degree.
That's awesome.
Certain areas of it because it just wasn't destroyed. But yeah, I mean, I don't want to think about the Roman Empire any more than I did today already. So I do want to point out that Wid says that's a great way to frame it, Bobby, and very good answer, Mr. Rhind.
What did he answer? What was the one he's referring to?
About the CDs and
gotcha.
Right.
Okay.
System. So
I mean, look, I think it's like everything. You're going to get boomers, retirees that are perfectly happy taking risk, and again, everything is about tolerance and about time horizon. So one person's 10% is another person's 3% in terms of risk tolerance. So we see it all, and I think the trend in my mind is definitely towards or to more risk taken as opposed to less, and that's maybe the most direct thing to say. That it's not that CDs are dead or bank deposits are dead or anything like that. It's just as rates come down, I think you'll see more people having to move as these kind of products either move just in line with inflation, i.e. can't keep up with inflation, or outright, fall below.
So you live currently in one of the worst / best real estate markets in the United States. You also live in one of the most rent-controlled cities, along with San Francisco. And those are the two cities that I'm obviously leading the question here. Those are the two cities that have some of the worst situation for startup housing, right?
Yeah.
We've asked everyone we've talked to in the last few months, do you see any, in your mind, do you see any solution to, I hate the term affordability, Jimmy. We got to think of something else.
Yeah, but
just
that's
for
the right
younger
word
people to get into homes, right?
I mean, look, the one big thing I would say coming from Europe that I don't hear talked about enough is there's never a real discussion about infrastructure transport as being an unlock to affordability. So again, if you take New York, you can widen out the spectrum or widen out the geographic distribution of homes. A home you bring a 10-mile home that's out 10 mile not commutable today into the commutable district, then you have a big unlock. And I don't really hear any real discussion on improving infrastructure, improving transport. So
You're
that you
talking about bullet trains a la Asia, where you can live in Quito and work in Japan, and the train goes 450 miles an hour. Is that what
Yeah.
that's what you're talking about, right?
Yeah,
Yeah,
I mean,
it's
to give you an
ridiculous that we
example,
can't do that. What's that?
So the Connecticut suburbs closest to New York, give or take, are about 35, 40 miles from the center of Manhattan. There is no way that journey should take an hour, which it currently does today, give or take.
Yeah.
So that is madness in terms of efficiency. And therefore, if you were to make that same journey 20 minutes, well, now you're bringing in an area that's not 40 miles away, 80 miles away, 100 miles away. People might be able to commute from 100 miles away very easily every morning efficiently. And that would unlock loads of cheaper housing, which no one has access to today because they can't do the commute.
This is actually a focal point of Thomas Sowell's book, Economic Facts and Fallacies. He said we don't have a population density problem. We have a transportation problem. That was one of his things. And he actually used Chicago as an example, where he said there's plenty of farmland in Indiana that is no longer paying for itself, where you could build just absolute cities worth of homes if there was a quick and easy way to get to Chicago to work. And that book it's 20 years old now at this point, I believe. Speaking of West Virginia, go ahead, Will.
No, I was saying it. None of these things will be the silver bullet that everybody expects, but it makes a massive difference. And I always think about, just in my time in London. London's a big city, very largely geographically dispersed. And what was always happening, because you couldn't build, there were zoning restrictions in like US parlance to build up. So people only could build out. And the only way you could build out was to unlock via transportation. So better transportation going further out, bring in different areas of the city or parts of the greater sort of London into play. And, again, you build houses are very affordable or more affordable as you go out. You have to commute further, but that's possible if the transport's there.
That makes such a crap ton of sense that I know that our government will never actually do it because it makes a crap ton of sense. So can we go back to the metals market and because I know a lot of people want to talk about metals. I've gotten some discussion. I mean, some DMs about that. Do we think, Bobby, I'm going to put this to you first. Gold and silver. We've been a gold and silver bugs for 3 or 4 years. What the hell are we supposed to do now?
So it's interesting. I actually just talked to my wife about that, as you know, and I know you're in the same situation.
She's smart, but is she an expert on technical analysis?
No, she's not. She's an expert on making me not do stupid things.
Got it. Yeah.
And that has been since I've known her, by the way. I have no more scars on my knuckles because of her. But
good, right?
We were talking this morning, and she said, "So what do you think we should do?" And I said, we own a lot of physical gold, as I know you do too, Jimmy. And as I look at it, I'm like, we might need to call our friend over at the metals company, right? Dana Samuelson.
Daniel Samuelson, yeah.
Right. And just cover some. It's not like about rebalancing. It's like when the last time we talked about selling some gold, it was at 1980, right? And I said, you know what? I think it's going to 2,800. A little while later, we're way past that, right? And she said to me, well, I don't understand. This is the part that she adds, Jimmy, just for your information. She said, well, I don't understand. You wanted to sell at 1,900. Now you don't want to sell at 4,700. And I have to go, that's a really good point.
I did sell some paper gold today and silver.
Yeah.
Did you guys sell any today? I mean, it's up 7% silver on the day in a tax-free account. I was like, okay, I'll give you some there. Will, did you feel the pull to sell anything today?
I would say that throughout the last year, it's been massive accumulation. So in terms of what we see, people piling in. I think what's unusual this time around is sometimes, or in other previous gold highs, gold is at a high when markets are low, or when something else is
Breaking.
broken down.
Yeah.
And the obvious question for me is, okay, if you're a seller today, I get the point sort of philosophically, but then what are you buying that is value? What are you
Okay.
going
I
into?
did buy some SPY because down 2% days, I do try to
Yeah.
accumulate a little bit. But I did sell out, not a ton of gold and silver, probably about 3% of my position, which, by the way, is still more than I had yesterday based on the move today. You know what I mean? So, yeah.
So
But
I have a friend that sent me something prior to me and my wife having this conversation. I want to read it to both of you guys.
here,
By the way, Will, I didn't say your English accent. I just said your accent because I wasn't sure.
I said English. I was wrong.
Well, also, if you feel like saying I'm fixing to light you up into the holler, I'm mad as a wet hen, feel free.
Can you please say that, Will? Could you?
No, leave him alone. So he sent me
Don't tempt-
something that I read while I was watching the Bears game. I was kind of looking at it, watching the Bears game. And here's the opening paragraph. The above is the most recent U.S. exports report on gold. The net U.S. trade deficit was down in no small part to the huge jump in gold exports by the U.S. For more than a decade, U.S. non-monetary gold exports ran roughly at 1 to 3 billion per month. That regime ended in late 2024. By October 2025, exports for gold, non-monetary, exploded to 17 billion in a single month. That's from 1 to 3 billion per month. What he says here is this is not volatility, seasonality, or jewelry demand. Non-monetary means physical bars changing custody, not central bank bookkeeping or swaps. When gold leaves this way, it isn't chasing yield, it's chasing control. The destination matters. Nearly all of that October gold flow surged to Switzerland. Now,
But
the
just
line
because
that
it surges
struck
to
me-
Switzerland, it could be central bank buying, just holding it in Switzerland, correct?
Yes, and later in the article, he implies that Switzerland is basically like a transport service. They don't hold it, and he claims that most of it's going to the Middle East and Asia, and that's why he believes that it's about control.
Yep.
That to me means $7,000-8,000 gold. It really does, especially CME gold.
And it also, Will, we're going to throw this question. I just want to add to the question too. Going into 2026, we wanted to believe that geopolitical tensions were about to cool down a little bit. Guess what? Not so lucky. So do you agree with that? Do you think central bank and sovereigns amassing gold positions is going to fuel this next leg higher?
Yes, but my nuance is that's been happening for well past the last decade. So
2017, it looked like it began in earnest. Back then, 64% of the world's sovereign wealth was held in dollars and treasuries, and now that number's dwindled to 56. I did not mean to step on you with some weird statistic, but anyway, go on.
No. I think it's part of the de-dollarization, theme that you've got banks around the world, central banks around the world that have been net buyers of gold. That is a big support for the market, and that will continue. I just want to make one comment about the Switzerland piece, which is kind of interesting. So back in 2011, when gold peaked, after the financial crisis, and then sort of crashed around 2013, we saw that big trend there. So a lot of gold came out of the GLD and other gold backed products, ETFs, etc., here in the US, and went to Asia. And what's interesting is the reason why, or one of the reasons it goes to Switzerland, is because that's where some of the largest refiners are in the world. So the market in China, as an example, and Asia more broadly, they like kilo bars, which is a different size bar than we have typically in the United States or in Europe. So typically what's involved is those bars get sent to those refineries in Switzerland. They're then re-refined into kilo bars, which is the sort of more accepted standard in Asia. And then that's where they're repurchased by buyers in Asia. So that's a kind of an interesting trend that, that is, going through Switzerland, getting refined into kilo bars, and then ending up in Asia.
So last year, Morgan Stanley, or it could have been JP, changed their model portfolio from 60-40 to 60-20-20. But the question is when you guys who are watching, our audience, they're smarter than we are. They know what I'm talking about. But for someone who might have just tuned in, the 20% is gold instead of bonds. So the question I'm going to ask is that, has this filtered down to the retail level yet? And you're probably the best person to answer this question because you sell products that create exposure to it. Do you think the average retail investor has the allocation into gold that they want to? That's the wrong way to put it, because right now they'd want to have 100% of gold just for today. But do you think that the retail trader does have an allocation?
I think it's moving more in that direction. So maybe let's put it like this. 10 years ago, I would say that gold was something that was very specialized. And in other words, there was a community of investors that loved gold, and that was somewhat niche. In other words, it wasn't mainstream.
Right.
So I'd say that has changed dramatically. And somewhat ironically, crypto has been a big enabler of that in terms of sending a message of alternative assets, something that's not dollars, something that's independent from the current financial system, something with scarcity, something with store of value characteristics. And I think whether or not that's, people's cup of tea or not, it's sort of subliminally, I think, reinforced the value proposition of gold. And now we're seeing a younger generation, or the investment in gold skew younger than we've ever done before. I mean, typically it was, again, much older, boomer kind of generation, investors that were sort of had a natural distrust for government, for the policies, the big spending, etc. Now that's skewing a lot younger, I would say.
But is there enough dry powder left? Is there enough people that haven't participated yet that could fuel the next meaningful leg higher, particularly when juxtaposed against central bank buying? You still think that's the case? Yes.
Yeah, I still think on any measure, gold's allocation in a portfolio is underallocated or underinvested, whichever word you like to use. I think if you were to take like the global asset allocation, my guess is today gold's still around 1% of the portfolio. So does it move to 2%? Can it move to 2%? That's a big move.
Yeah.
And there's no doubt in my mind that one of the things, going back to CNBC, you mentioned, I just don't see the mania. And I've seen the mania in past cycles where every second segment on CNBC was talking about how gold was in a bubble, and you'd have every talking head, pulled on to give their analysis on why gold was in the bubble and why it was going to crash imminently.
Right.
I haven't seen that this time around.
So the first guy I see that comes on and says gold's a bubble, I will increase my allocation to gold. The 1,000th guy who comes on and says it's a bubble, I'll stay neutral. And then the first guy who says, I guess we were all wrong, it wasn't a bubble.
This time it's different.
Right. Yes.
Bobby, yeah, I just don't see the signs of mania today that we've seen in other cycles.
Let me add some of that real quick, Bob, before I give you that question. When stocks crapped out in 01, when real estate crapped out in 08, it was mostly a question of people leveraging up to buy those assets. I don't know anyone who's borrowed a ton of money to buy gold. And I know there's leveraged ETFs, but those, to me, it doesn't seem quite the same thing. You're just going to lose all the money you put in the ETF. You're not going to get a margin call. To me, it doesn't seem like, I don't think anything's in a bubble, because I think most of what we're seeing right now is just a dollar that's decreased its purchasing power by 35% over 5 years, and everything else has gone up reflexively, and some things go up at different rates. Bobby, does that sound realistic?
Yeah, it does. I mean, that's, again, why I want to steal Rick Santelli's phrase, which I always picked on him for, is we'll have to wait and see. I mean, there's a lot of things going on, not the least of which being what I just read to you guys. If it's accurate, I assume it is, because I know the source. And, the central bank buying, he's claiming this isn't central bank buying. And it makes sense to me that other governments are reaching for as much control as they can get.
You said it isn't such. You mean it is central bank buying, or it's sovereign buying, right? Countries are
Well,
huge.
yeah, central bank, sovereign wealth funds, a reach for control. Yes, in general.
That makes
So
sense.
when I see that kind of a thing, it just leads me to believe that, we went back to the idea of I can't find a reason to dump gold. Right now, even rebalancing doesn't seem to make a whole lot of sense to me. I mean, we're up 3.6% today, 3.7%.
Yeah.
I was looking through my chart without
huge
actually
move.
searching it, trying to find the last time that gold was up this much. It's not in the last 2 years
Wow.
in one session.
You know what, Bobby? You have to go back to the 1970s to see those kind of moves and those kind of numbers in terms of a 60% year-on-year return for gold. That's unprecedented until you go back to the 70s. And you look at that environment, and that environment closely mirrors what we're seeing today in terms of what's happening in gold and silver.
So let's get to the Fed then, as long as we're talking about the environment today. My thesis of this, and let's comment on it, is that the labor market is soft. The Fed is pushed up against a wall. They realize that macroeconomically, things aren't so bad. And it's mostly the K-shaped. I hate saying the K-shaped, but it is real. And the people, the asset holders, are spending money just fine and driving the economy. But the Fed's caught in this spot where they think they have to ease to support the labor market. But the labor market might be soft because of perceived efficiencies created by AI. And I say perceived because I think in the end, some of these companies who aren't hiring because of AI might be disappointed with what it can actually bring to them. And they may right the ship in 6 months, but it's not unusual for disruptive technology to negatively affect the job market on the shorter term. So the Fed's got to ease into not a booming economy, but economy that's certainly not slowing down. We're expecting 4.3% on Friday. Will, you go first? Poke holes in that.
I think that that's the situation that they're in right now, and inflation numbers have been much better than expected. They're still a little bit higher than where the Fed probably ideally wants them to be target wise, but certainly a lot better than most people expected, and certainly a lot of the inflation bears. So this has become a situation where, from majority of measures, the economy is performing well. So what is the logic to reduce rates? There's not a really strong argument, I think, if you're looking at the data, other than the president / the administration wants to see rates lower. And maybe your default is, well, other countries are doing it, and therefore we don't want to be left with the highest rates and therefore be uncompetitive. We want to have a weaker dollar. We don't want to have a stronger dollar in an environment where other countries are easing as well. I think the risk is, in my mind, is to the downside. Is again somebody coming in. We know that Powell's leaving. Let's just say, in his official term, ends in May, and whoever's coming in, we understand will most likely be, or almost certainly will be, under a
Trump
view.
bootlicker. Is that what we're going to say, or no?
Someone who will reduce rates a lot faster, a lot quicker.
I don't have a boss. I can say Trump bootlicker. No one's going to fire me.
So going toward that, President Trump, I think, feels a bit emboldened, and it sounds like I'm against the president specifically. I'm not. Jimmy and I were beating the drum for a long time that tariffs wouldn't cause sustained inflation, that at worst they would cause a one-time price increase that would then wash away over time through wage gains. And I think he's been proven correct. I remember people saying tariffs cause inflation. And then from there it went to tariffs haven't caused inflation yet, but they will. Now you've actually got people coming out and saying, we don't understand why tariffs didn't cause inflation.
They should have asked us, because we laid it out pretty damn clear why they wouldn't cause that much inflation. But anyway.
I am breaking my arm to pat us on the back.
No question about it. We deserve that.
Over and over again.
Yeah.
Now you've got, but what you can't have is the administration coming out every 2 weeks announcing a new tariff. Because then every single tariff is a new one-time cost adjustment. That's almost the definition.
That's called embedded tariff inflation.
Yeah, tariff. You just created that. No one has said that ever before. So when you look at it from that perspective, has it gone from terms of the potential rate cuts? Can a new Fed chair actually come in and say, look, the president wants rates as low as possible as long as the economy is strong, right? And can a new Fed chair come in and go, look, Mr. President, happy to do that. I agree with you, but shut the fuck up? Do
You
you think
can't
that a
tell
Fed
Trump
chair
that.
would have the what?
You can't tell Trump that though, right?
Well, you could. I'm not sure he'd listen.
Or
Yeah,
you
I mean,
get fired.
You're getting appointed for a 10-year stretch, right? And I'm calling it a stretch like a prison term
Look,
deliberately.
this is where the kind of the vision, I suppose, it comes in, and you ultimately believe what you believe. There's an opportunity. You can look at it one of two ways. You can look at it as being just a purely, hey, bring rates down, all things being equal, that brings fire to the economy. That's better for everything. It's better for easing financial conditions, everybody with mortgages, with auto loans, credit cards, etc. And that's probably the more logical interpretation. But I think there's also an opportunity to say, if there was a bolder vision, maybe to say, let's bring rates down as fast as we can. We've heard certainly the Treasury Secretary talk about it a number of times, albeit not in this exact context, but the financing of the debt, the amount of money that the US government's paying in interest on
$9 trillion
debt.
needs to be rolled this year of bonds, and another $2 trillion to do the deficit of two. So that's 11 trillion bonds that need to be sold. Sorry to interrupt you, Will. Yeah.
Yeah, but there's an opportunity potentially to do some refinancing here by bringing rates down to a very low level and maybe doing longer bonds. But there's some refinancing work that could be done to affect the debt, put us on a different trajectory. Now, whether that will happen or not clearly is a key question. But there is that opportunity, which again people would have to argue is the benefit versus the risk. Is the risk of doing that worth taking? In other words, trying to put us on a better, more sustainable path for paying off the debt or paying down the debt versus kicking the can down the road.
Interesting. Bobby, you got any last question or no?
Yeah, I got a last one for you. So I want to talk real quick. I spoke at a Bitcoin conference. I didn't speak, I moderated. I was the traditional finance guy, considered a skeptic, questioning three pretty well known Bitcoin enthusiasts, for lack of a better word. They all had good things to say. I mean, they all had good points, but all of their points, in my view, depend on the idea that Bitcoin can actually work where governments don't seem to want to give up control of the monetary system. So where do you stand on Bitcoin at all? You probably have some ETFs. You correct me if I'm wrong, that either include Bitcoin or are Bitcoin focused. That's become a big thing. And that was one of the point of contentions of a lot of people there as the institutions are getting involved. But I think, I don't remember who said this to me last week, Jimmy, it might've been you. If there's a maraschino cherry token, the funds will sell it to you. They don't care. BlackRock will sell you jars of maraschino cherries if you want them. Doesn't mean they believe in them as an asset.
I think that's honestly the better way to look at it, Bobby, is I see so much commentary on, firms doing this and that, and people, I think, making the leap of saying the firm themselves is somehow endorsing it because they're doing it. Like, I very much view our job as to give the people what they want.
Right.
We build products for investors. It's not our role to really
Not endorsing
determine
the products.
Yeah, like we're not the arbiter of taste, right? It's not up to us to say,
That's a great
hey,
phrase.
you should only be investing in this, that, or the other. It's like, if people want something and it's not absurd, then it's up to us to give them exposure. I think, providing it's not dangerous. So I don't particularly have a strong view on it, other than I've now been around, I think, around long enough to think that you have a critical mass of people that invest in it, that believe in it, or allocate capital to it. And so from that perspective, with the scarcity, I think that it's in a cycle whereby people will argue whether it's in a retracement or whether it's just consolidating. But I've no doubt that we'll have another up cycle at some point, because I think the the amount of people that are out there that are convinced that something, and again, this narrative of increasingly having something that's independent from traditional stocks and bonds is very persuasive. And it's something that, particularly outside of the United States, where maybe we sometimes take for granted that we don't have these issues in the same way that the countries around the world, some other countries around the world, have these issues, whether it's rampant inflation, whether it's currency controls,
Right.
whether it's, all sorts of political turmoil, that assets like gold, like Bitcoin, but obviously gold has been around for thousands of years, they're attractive for a reason.
Well,
Yeah.
again, Bitcoin didn't participate, Jimmy, in the safety trade. It's down over 3% right now.
Crazy.
Michael Saylor is now up to 700,000 Bitcoin. So it's, what is that, 63 billion, somewhere in there? I don't know.
Holy
I'm not doing
crap.
the math good. But I will tell you real quick that, again, it's correlated to the NASDAQ again. And that was something I told those guys, that has to change.
Except there
if
are
you're
some
going to
days where it's
say-
not, but it usually is correlated to the NASDAQ. Yeah.
It's correlated to the NASDAQ and the downside. That's what bothers me about it. And here's the last one, Will. We'll do it here directly, Lord willing, and the creek don't rise. Till then, just sit tight and hush your mouth. I'm not going to ask you to say it.
Can I play us out here, Bobby?
You can bet.
Yeah,
You can
that's it.
bet
I'm
that.
done. Americans think you guys are all William Wallace anyway, so it doesn't matter.
Will, when we have you back, we're going to have you do the West Virginia things. Can you tell the people where to find you and where to look at your products?
Yeah, so the company is graniteshares.com. That's our main website. Or I'm at Will Rhind on X, for those who are on X, and Granite Shares as well on X.
Fantastic. And thank you
And
so much
Bob,
for
your
joining.
uncle. There's another show.
Right. I would like to thank our sponsors. First, Independence Arc Farms. We always complain about big conglomerates controlling the food supply. There is something you can do about it. Contact independent operators, small ones like Marco at Independence Arc. Also, American Gold Exchange, Dana Samuelson. The link is on our page. And lastly, Unfiltered Investor. If you get a chance to take advantage of Mike Arnold and Bobby Iacino's technical analysis, you take it. This has been the Future's Edge. I'm Jim Uro. That's Bob Iacino. That's Will Rhind of Granite Shares.